Hello and welcome to SKANS eCampus. SKANS eCampus is a gold-approved learning partner of ACCA. On this channel, we bring you demo videos of different courses available at SKANS eCampus. So don't forget to subscribe to our channel to get notifications of additional videos and hit the like button.
This video is going to cover techniques for questions from the planning stage of audit, where you're asked to evaluate audit risk with the help of preliminary analytical procedures. Before we go on to the actual question, a few things that you can keep in mind which would help you manage your time in a much better manner. If you look at the requirement, which is going to be a typical requirement for this topic, the requirement says you need to perform preliminary analytical procedures, and using the results of these procedures and other information, you have to evaluate the audit risk. Remember, when we say audit risk, this covers risk of material misstatement along with a few detection risks that she might have given as well. Now, the recommended sequence of attempting this question is you should be able to calculate and comment on trends from the information given. So when I say trends, that basically means percentage changes and evaluation of relationships of different items within the financial statements. So for example, if I take the commonly tested trends from the past exams, your changes in sales compared to changes in cost of sales, or operating expenses and finance costs, etc. So for example, if the long-term loans or non-current liability have gone up with the interest-bearing elements, but the finance charges or cost have gone down, then you would know that there's a risk that finance cost is understated. I then want you to calculate and comment on ratios for both years. I keep saying calculate and comment because please remember, there are absolutely no marks for calculations in isolation. You will have to link them to risks. Otherwise, even if your calculations are correct, you'll get a big fat zero. So when I say calculate and comment for both years, there's a list of commonly given answers, commonly given ratios in the answer that you should use as a guideline for your evaluation. So for both years, you could calculate the operating profit margin, current and quick ratios, inventory holding period, receivable collection period, trade payables payment period, gearing, interest cover, and effective tax rate. Once you've done all these calculations, you can then go on to start writing down your answer. Again, the sequence in which the answer should be picked up and written, we'll be discussing that through a question just now. But the key information that you need to retain from this slide is that trends and ratios, the calculation element, will have separate additional marks only if you link them to relevant risks as well. Please remember, you're acting as an auditor. This is not a financial reporting exam where you try and justify the increase or decrease, or you're not giving reasons for it. You have to link them to possible risks in the financial statements. For example, and this is one of the past exams, if you look at the screen, this says analytical procedures reveal that the group's revenue has increased by 19%. If you stop over here, that's a 0. But then you go on to comment on it as well. The operating expenses have increased by 25.6%, which does not make sense. So that's your comment, resulting in the fall in operating margin from this to this in 2016. So on the base of this answer given, you get marks for the calculations, plus you get marks for what's written in green as well. Again, you talk about the impact on risk. Operating costs are overstated or sales are understated, and then you talk about the risk, or explain it in a different manner as well. So the idea behind this example is, because you don't have the background for this, so this might not make sense to you, but the main idea behind this screen is that the calculations will have half a mark for each calculation only if you ensure that you link them to potential risks as well. We're now going to be doing a question on this topic, which is basically audit risk with analytical procedures. All right, so suppose you open your question paper in the exam, and this is what you see right at the start. I'm going to, I'm assuming you've read the case study once, so I'm not going to be reading it with you. So once you've read the case study and understood what has happened and the flow in which the information is given, I'm now going to read this again to find answers to my questions. So starting off very quickly, let's just look at the requirement first, because I have read the case study once already. I can just focus on the requirement now. So I have to evaluate the audit risks to be considered in planning the group audit. So it's a group audit. You should use analytical procedures to assist in identifying audit risks. You are not required to consider risks relating to disclosures as these will be planned for later in the audit process. So your examiner pretty much is saying that I'm not going to give you marks for any answers relating to disclosure requirements. So she's sort of putting in a filter in terms of what you can get marks for. So now I'm reading the case study the second time. So I'm the audit manager in the audit department in Bison & Co, responsible for the audit of Eagle Group. I know this is a group which has a financial year ending 31st December 2018. So your firm has been appointed the auditor of the parent company and all of its subsidiaries, with the exception of Links, a newly acquired subsidiary located in a foreign country, which is audited by a firm of local auditors, Vulture Associates. Now, because I've done my revision kit and I'm fully prepared for this exam, out of the 24 marks, my first risk comes over here, which is high detection risk. So one of the subsidiaries is audited by a competent auditor. I'll have to rely on their work, and that increases detection risk. So the easiest mark that you could have gotten, this 1 mark I'll convert into 2 as I read information as we go along. So the list of exhibits are given. Fine, I read that and I know what the requirement is. I can now move on to the second page. Again, the first time when I read this, I was just understanding what had happened. Now I'm actually looking for audit risks. The group, which is a listed entity, operates in distribution, supply chains and logistics, etc. Now, very, very important. Once again, because I've done my past exams and I've done all the practice questions, I understand that for listed entities, there's a very, very easy mark regarding risk of material misstatement linked to window dressing, creative accounting, earnings management, or manipulation of financial statements, whatever you want to call it. Because, of course, there's stakeholders in the general public who are monitoring the performance of a listed entity, so they are automatically problematic or risky, such clients. So another easy mark is that the risk is that the financial statements could be manipulated, resulting in overstatement of assets and revenue and understatement of expenses and liability. And I'll be getting more information about this, but even if I don't link that to this information, for listed clients, this is automatically an easy mark that you would get. So I went on to read all this information and okay, I have understood what's happened. The main part that I need to retain from this is approximately 5,000 staff were made redundant early in this financial year due to automation of their work. One thing that you need to understand is please do not write risk of provision related to redundancies, because this happened earlier in the year. So if this happened at the beginning of the year, this would have been paid. There's no need for provision at the year end. So we can't just pick up a word and assume this is what they're saying. Please make sure you read the requirement very, very carefully. This is where my actual answer is going to start from. Now, in the actual exam, the first thing I have to see is making sure I'm doing a comparison of like with like, because there were some questions where the actual information was for 12 months, but the current year's information was for 11 months. So if you don't look at that, you would be doing incorrect analytical procedures, because for this elements, of course, you can't change the SOFP. That's not time apportioned, but the P&L items will need to be time apportioned if the current year's information is not for the full 12 months. So the first thing I'm going to see is, okay, this is for 12 months. With 12 months, I have no issue over there. Now I'm just going to slow down and focus on the techniques that you need to use for picking up the risks from this question or questions like these. The easiest way to manage your time and get marks is focus on the areas which have notes given, because those would have the most risks. So keeping that in mind, step number 1, I'm going to have a look at goodwill. So goodwill, note number 1. Before I go any further, I need to see that there has been a change in the goodwill. Okay, I'm just going to write that down. This has been a change in goodwill. The first thing you have to do is look at the areas in the balance sheet or SOFP where the notes to the accounts are given as well, because these are going to be your easiest marks. So if you look over here, goodwill note number 1, from 970, it has gone up to 1100. And so there's been a change of 130. I need to write this down, because whatever information is given in my notes, I need to make sure I compare it with this 130 as well. So I'm not looking at any further information right now. I'm just going to be reading through this at the moment. Okay, so let's go to note number 1. Goodwill relates to the group's subsidiaries and is tested for impairment on an annual basis. Management will conduct the annual impairment review in December, but it is anticipated that no impairment will need to be recognized this year due to anticipated growth in revenue, which is forecast for the next 2 years. Now, I understand they're doing an impairment review, but please remember that impairment does have a lot of assumptions as well. And if you look at this information, you'd see the revenue has actually decreased. So when I was reading this information, I can see that's actually gone down. So my next risk is this assumption that maybe, well, what the management is saying is there's going to be no impairment of goodwill. This is too optimistic, and therefore your assets could be overstated. So another easy mark. Normally, it will not mention if a review has taken place. So you could have written the risk is they've not done an annual review, but in this case, they've specifically mentioned this. So all you have to do is this seems too optimistic and the risk is goodwill is overstated. Remember, this is ROM, risk of material misstatement. So you have to link it to under overstatement. In March 2018, so this was not done at the beginning of the year. This was done in March. The group acquired 80% shareholding in Links, a listed company located in a foreign country, for a consideration of 351. Management's determination of goodwill arising on this acquisition is shown in Exhibit 4. Now, even if I do not go any further, I have lots of easy marks over here. Remember, my income and expenses will need to be consolidated from this date. So my next risk is, and when I'm reading this, I'm picking this up. My next risk is that maybe they've done the consolidation for the entire year and then profit is going to be understated, because actually when I read further, this is a loss-making subsidiary. So I would have consolidated the loss for the entire year rather than from March 2018 onwards. So I'm just going to write this down. Therefore, profit is understated. Apologies for that. Profit is understated as Links is loss-making. Again, because I've done my revision kit, I know there's some very easy marks over here related to your foreign currency transactions. Lots of easy risk marks over here. So you know that according to IS 21, assets and liabilities need to be retranslated at the closing rate, income and expenses at the date of transaction, and this would have an impact on goodwill too. And any gain or loss goes in OCI. So the risk is all of that has not been done. The rates could be incorrect. The gain and loss has not been charged in OCI, and therefore there could be lots of misstatements over here. So I'm only focusing on note number 1 at the moment, and this is what I found. It also mentioned that information is given in Exhibit 4. So let's cover this right now. I'm going to go all the way down to Exhibit 4 and have a look at the risks over here. So again, there's cash consideration, contingent consideration, fair value of non-controlling interest, fair value of identifiable net assets. Once again, so there's some notes given. Let's start talking about this. The contingent consideration is going to be payable. All these conditions are given. When I was reading the information, I understood that this client's weighted average cost of capital is 10%, but they've used 18%, which is very high. So misstatements over here is another risk. This contingent consideration is dependent on certain targets, their profit targets. And again, I'm worried because Links is loss-making. Loss is forecasted. I'm just going to write this down. So maybe this contingent consideration cannot be recognized. So another risk over here. If I've done my revision kit properly, I know there's some easy marks over here as well. Fair value, again, this is subjective. There are risks that maybe not all assets have been, or liabilities have been identified. So for example, there could be contingent assets and liabilities which are missing. So easy marks over here regarding the fair value workings over here regarding risk. This over here, the expert has done the valuation. It seems independent, that's okay. But then again, when you rely on the work of an expert, you could link this to detection risk as well. Because remember, this detection might, expert might not have the competence, etc., etc. So out of 24 marks, I've covered a significant portion simply by reading through note number 1 of goodwill. Just before I go back, look at this. The goodwill which relates to Links is 100. I'm going to go back to this page over here. I'm now worried about the remaining 30. So I understand Links has 100. Where did the rest of the 30 come from? Another risk over here. So I'm worried, and the risk is that there could be overstatement in goodwill because I have no idea where the other 30 is coming from. I then go on to other intangible assets, which is the next note. Again, like I said, it'll be easier if you just stick to the notes first. There's been an increase from 170 to 200. So there's an increase of 30 over here. And this is again explained in note number 2. Let's go all the way down to note number 2. This is exactly what I would expect you to do in the actual exam as well. Stick to these figures so that you can manage your time as well. So now other intangible assets relate to mostly software and other technological development costs. During the year, 35 million was spent on a new IT system, 20 million on development into robots, and 5 million into a new accounting software. They're all being amortized over 15 years. Problem number 1. This comes up to 60 million if you add all 3. However, the SOFP only shows 30. That's the change that I just calculated. So again, my first concern is, why is there a discrepancy over here? My first risk. My second risk, obviously easiest marks that you could have gotten, was the IS 38 criteria. So again, the risk is that maybe these do not meet the criteria of intangible assets, and therefore assets could be overstated and expenses understated. My third risk related to intangible assets is the 15-year useful life, which seems too long for IT intangible assets. Plus, how is it that it's same for all categories of intangible assets? So remember, there's a new IT system, there's some other research and development into robots. This doesn't make sense. So I have 2 concerns about this. Number 1, this seems too long. Is this a way of manipulating the financial statements? And number 2, Why is it same for all intangible assets? So my second category is now also covered. The third one is share capital from 1150 to 1250, and it says note number 3. A share issue took place which was used to fund capital expenditure. There's no risk over here. Please remember, it's a listed company. Issuing shares does not necessarily mean there are going to be problems. So that's absolutely fine. I'm going to move on to the next one now. Non-current liabilities from 620 to 650, note number 4. Okay, let's go over here. Non-current liabilities include borrowings of 550, which were 500 last year. So my borrowings have gone up by 50, and provisions of 100 million. Changes in financing during the year have impacted the weighted average cost of capital, which is currently 10%. I already knew that because I'd done the comparison when I first read the information. Now, before I go any further, there's been an increase in borrowings. I should instantly go and have a look at the finance cost or the finance charges. There you go, you have your next risk. My borrowings have gone up by 50 million, and yet the finance charges have gone down by 2 million. Therefore, risk is that the finance charges are understated. Remember, that's a trend or a relationship that I would immediately comment on because I've done my past exams, and that logically makes sense as well. The next note is note number 5. Revenue has gone down, and the details are given in note number 5. Let's go have a look at this. You'll have to keep doing this, by the way, in the actual exam as well. Keep going through the information so that you can refer to the notes. Revenue has decreased by 3.7% because a new competitor came into the market. Of course, that's fine. There's no concern over there. It's reflected over there. The next one is other income, and then other operating expenses as well. We'll be looking at both of these now. Okay. Now, this is something that your examiner has been testing frequently now. If you look at the other income from 80, it's gone up to 120. There's been a change of 40, and that's exactly what should have been reflected over there as well. Yeah, so it's fine. So this matches. 80 and 120 matches as well. Okay. So let's look at the details. The reversals of provisions have gone up from 40 to 60. For impairment losses on receivables from 20 to 30. Foreign currency gains have gone up as well. And from a loss on disposal, there's now a profit on disposal. Remember, this is a listed company with higher chances of manipulation, and that's my biggest concern over here. So if you did not pick it up from the last line, you could add on to that one mark as well. This is a listed company. There's a risk that this could be biased, and therefore income is overstated. Again, particularly when we talk about reversals of provision and impairment losses, this is a very easy way. This is an issue called profit smoothing. This is where you're going to book higher provisions in the years that you've done well, and then you're going to reverse them in the years that you're not doing well in. So again, the reversals going up could have been done to boost profits. So maybe this is not a genuine reversal, and therefore your other income could be overstated. So revenue has gone down. I couldn't really manipulate that because a new competitor came in. So forget revenue. I'll just manipulate the other income. If I now go on to other, operating expenses, that was note number 7, 5,800 gone down to 5,540. Let's have a look at this now. So 5,800 gone down to 5,540. That matches. There's no change over there. My first concern comes from the staff cost. From 3,610, it's gone up to 3,650, which does not make sense. This is an increase of 1.1%. I get separate marks for this trend calculation. It does not make sense because I've done redundancies. So at the beginning of the year, I made some of my workforce redundant. Why has the staff cost gone up? if you look at other operating expenses, there has been a drastic decrease. So maybe this could possibly be a misclassification error. This huge decrease is inconsistent with other trends. So maybe this is either understated in isolation. This could also mean there's some misclassification between staff cost and other operating expenses as well. So that was my next concern over here. If I go back to my information, my SOFP and P&L extract, I've now covered all the notes to the accounts, and pretty much most of the areas have been commented on as well. You could, if you still have time left, look at the other information, the other figures as well. But pretty much once you've covered the notes, most of the areas will be covered. The ones left will be coming just now through ratios as well. One last thing that I have to do, I'm going to go all the way down and show you. I was reading this information, I was picking up the points, so that's already covered. This is how I found out that links was projected to be loss-making. I would have underlined this and I've done my working as well. I now need to conclude, and this is what I'd recommend that you do. Once you've done your risk assessment through the notes that we just discussed, and these covered trend and normal risk assessment, you can now calculate the ratios and comment on them as well. So if you pause the screen for a second, you'd see that I've calculated the ratios. Just be careful, when I was calculating gearing, in my debt, I only took the borrowings, not the provisions, all right? So once I've done my calculation of the ratios, I could get marks on these calculations if I link them to the risk. I've spent so much time on discussing the risks, I understand what all of these mean now. So my operating margins, again, I'm slightly concerned that expenses are understated. We already discussed that. We already discussed why I think the margin could have improved, because the expenses have gone down. There's no concern in current ratio as such. They're still good to go. I get marks for writing that down. In terms of debt over equity, I've covered the comment through my finance charge discussion. Again, for interest cover and debt and equity, both are covered when I did my discussion around the finance charge. My operating profit has gone up, finance charges have gone down, although borrowings have gone up. So I'm worried that my finance charges could be understated. An extra easy mark was the effective tax rate. So when I calculated the effective tax rate, it's gone down from 25% to 20%, and I'm worried tax expense could be understated. So if I quickly go back, when I say effective tax rate, this is the tax expense divided by the profit before tax multiplied by 100. So this was, I think, 25%. This is 20%, and therefore I'm concerned that tax expense is understated. So just to wrap up, I've mentioned the attempt for this paper. By the way, it's September 2018. The answers are available. But what you need to keep in mind is that for questions on audit risk with analytical procedures, they are very, very technique based. You have to make sure you cover the question in the sequence I mentioned. So read the case study once, understand the key, underline the key points, read it again, start looking for the risks. Once I've found out risks from the descriptive portion, look at the SOFP P&L extract, make sure the year ends are the same. If they're not the same, time apportion P&L items. Please do not time apportion SOFP items. Focus on classes of transactions and account balances where notes are given. Most of your risks will be covered from the notes, and right at the end, calculate the ratios, comment on them, and then you'll be good to go.
If you like this video, visit our website www.skansecampus.com to purchase the complete course at affordable prices. Register today at no cost and access our free 10-day trial.